Welcome to The Mortgage Voice with Jeff Barton, your voice in the mortgage industry. Each week on this program, Jeff and his guests share their expertise, personal anecdotes, and the latest industry news to keep you in the loop. Now, to provide you with insight and help you navigate the consistently changing world of real estate lending, here is your host for The Mortgage Voice, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning into the show, for listening each and every week as we come to you via radio airwaves, KCAA out in the Inland Empire. I'm really happy that they have been, well, I've been with them actually for years, bringing you the signal as well as, the information that we try to impart. Mostly it's about mortgages and real estate and the effect that the grand scale of all we do here in the U.S. and around the world affects your decision-making and your ability to get a mortgage. How easy is it to get a mortgage in today's world versus what it was 18 months, 2 years ago? Well, it's a lot harder, right? And that's what the show is trying to do, is to try to point out things as they come along and at the same time be a little, long in the tooth, meaning that we have a vision in the past that we've been around for a long time, 10 years in the radio station, and I'm an old guy, so I've been around at least 50 years in the business, and I can tell you we've been through this before. Some of the things we aren't aware of that we are getting into are things like multiple wars taking money out of the U.S. coffers, inflation that hits a all-time high and then is slow to recede, the Fed hiking interest rates 11 times in 18 months. As we go through the difficult things that are happening both in the economy and in the news and events around the world and how they affect you and your decision-making processes, especially if you're trying to buy a house. We'll go through some basic numbers today and get to the heart of it. But if you want to see this show, you can do it each and every week. Go to YouTube, Jeff Barton, The Mortgage Voice. We're there on YouTube, been there for years and years and years, and we have hundreds of shows. You can go to the backlog, and I have people that actually email me and X me and, what's another one? Facebook me about all the past shows that I've been on. Like, people will binge watch the radio show. Go figure. I don't know why, but it happens, and it happens more than you think. Although it's funny that I say that, because I think also that there's a lot of phishing going out there, a lot of scams going on out there, and at some point, maybe later in the show, I'll read off a few of the major scams that are happening to people over their phone, and it's just amazing. There's no shortage of ingenuity and creativity when it comes to stealing my money. People try to do it all the time, and maybe you can relate to it, and that's what we'll get to. Anyway, I am Jeff Barton, and this is The Mortgage Voice. Let's get to the rates right away, because I think we've seen a retreat from a couple of things today, and this will affect mortgage interest rates as well as the Fed interest rate. 30-year fixed rate is 7.75%, 7.12 is the 15, 7.18 is the is the FHA loan. 7.95 is jumbo. That jumbo rate is still higher than everything else. Nobody wants to do jumbo, so that's why the rates are so high. And 7.17 for the 5/1 ARM. The ARM products are more popular today. Why are they more popular today? Because the rate's lower, obviously. And anybody who's getting into one of these products has to know firsthand up front that this is an ARM product, fixed rate for a short amount of time. And most people who do get into this understand that it's to their best in their best interest to convert this loan at some point. Most people are getting into it because it's a low interest rate. If an interest rate gets lower, then they should jump on it, or they're trying to get in and out of a property within 5 years, and that's what the 5/1 ARM is all about. It's fixed for 5 years, and then it goes into an adjustable, and the adjustable, I think, is 1 point a year, and it adjusts up to, maybe 12%. So it can be very high. These are the type of rates that really occurred during the 2008 financial crisis. That's what we're calling it now, not the mortgage meltdown or the fault of the mortgage broker downturn. No, we're calling it the financial crisis. And that financial crisis was really all about maturing debt when you were upside down in your house and what happened to the property. A lot of them just went BK, and large inventories. And you know what? This is a lot of where the current housing issue really was in its infancy, when large tracts of homes, rather than being put back on the public market, were sold to corporations, BlackRock, what's his name? Bill Gates' company has recently been doing it, but there were a bunch doing it, corporate housing, buying into large-scale developments of single-family residences in cities all over the United States, and instead of having people live in them as owners, no, they just rented them out. So the rental market really put pressure on single-family market because there just wasn't enough of it around. So what happens in that regard is that you get prices that continue to rise, especially when builders in any of these instances, but today being one of them, don't want to build as much as they should be building. We should be building 1 million houses a year. We're building half that number. So as each year and each and every year goes by, that shortage grows. And that shortage is really one of the reasons why right now we have a shortage of homes, the inventory, and all this is keeping prices high, even though we have mortgage interest rates that are near 8%. I said it was 7.75 for the 30-year fix. That's actually down from a little over 8% last week. And we see that as a result of what's happening at the Fed. The Fed, what did they do today? Okay, it's Tuesday, date of the recording of the show. The Fed held interest rates steady, meaning that they did not raise the 5.25% to 5.5% short-term interest rates any more than they have. They are targeting a 2% inflation rate across the board that we have not hit yet. And actually, I saw a very frightening statistic. And by the way, there is so much frightening in the news. I would say limit your news either online or however you receive it to an hour a day. Other than that, you're just going to get depressed and want to crawl into the covers. I just know that when news is bad and consistently horrible and you're subject to it, there's always a reaction to it, and that reaction takes your focus off what you either need to be doing for your family, for your kids, for your immediate job, or in what we do, preparing to buy a house, or looking at houses, or being able to refi, or taking money out of your house to be able to go to work for you so that in the long run you have either residual income or a nice way by which you can say, hey, I can retire this year. All these things are very, very important and need a focus and a really determined attention from you as the investor or as the seller or as the buyer. Okay, so the Fed holds interest rates right where they are, even though it's the highest since 2001. Wage growth is slowing. Employment slows. Let's see, payroll, private payroll last month, 113,000 estimated. Now we're going to see the overall employment and how many jobs were filled last month. By Friday, we'll get that. And construction spending is actually up, which is a pretty good thing because anytime that we have construction, in single-family housing, we look at that as a good thing, even though the numbers are small. But that is kind of how it is. Okay, the mortgage rate's a little lower, 8 to 7%, 7% to 8% loans. And as we mentioned, applications, though, are down. And the reason the applications are down, it's that time of year, right? We get to this time of the year where you go from Halloween to the New Year, maybe even halfway through January. And a lot of people, as I said, focus of attention gets on different things. There's a lot of family obligations during this time of the year. There's a lot of places that people want to go to, whether it's circling the wagons and being at home. So a lot of what goes on in the real estate and mortgage industry also slows, and this usually leads to a little bit higher interest rate, although you might be able to see an inventory uptick because that's the way people think, and therefore the houses on the market and houses coming to sale remain on the market, therefore increasing the inventory. So there may be a good buy or two out there for those of you who are still looking. Anyway, I am Jeff Barton. This is The Mortgage Voice. Really appreciate you listening to the show, and we'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for listening to the show, listening to us each and every week as we come to you from the towers at KCAA. Also, we're on YouTube, Jeff Barton, the Mortgage Voice. And we also have any number of different podcasts that you can plug into. Maybe you're familiar with some of these. Daryl, you got that list for us?
I sure do, Jeff. We've got Apple Podcasts, Google Music Play, Spotify, Spreaker, Stitcher, iHeartMedia, Radio.com, YouTube, of course, and Podclips.io.
Okay, excellent. Podclips.io. I plug them each and every week. I hope you go there. It's a great place, central place where you can come to any number of great podcasters. I'm there. Josh Lane, who does a health show, is there. A couple of guys for the ADR, which is alternative dispute resolution. Anybody in any kind of contract in real estate knows if you get into a problem, there are a couple of clauses there. One says mediation. The other says arbitration. That's what these people do. So if you're in any of those situations, or you just want to be educated as to what happens when, you should listen to these guys. They're great, and they're on each and every week. Podclips.io. Go there. I'm Jeff Barton, and this is The Mortgage Voice. Thank you very much for listening again. Okay, so in the realtor section, and I want to ask our guests, we have three of them here, three veteran loan officers who can just talk about what's happening not only in the market for their own clients, but what in general that they see and where we've come and where we're heading. One of the things that has been making news over the last 6 months to a year has been a lawsuit against the boards of realtors, the Realtors, National Association of Realtors, from a class action group from 2015 to 2018 or 19. I don't know. There's thousands of these people in this class action lawsuit, and what they're claiming and what they actually won in a couple of different cases was, hey, I'm a seller. Why am I paying for the buyer's agent? Why? And the court agreed with them. There was a trial concluded yesterday, and the number is astounding. It's going to total over $5.5 billion that companies like Berkshire Hathaway or Arrive or I don't know, Coldwell Banker probably Remax, probably, you name the company out there, Cochrane, any of these groups, they're all involved in what the court I guess it was a jury case that said that, hey, you know what? You're price fixing. You're colluding with all these people to keep real estate commissions high. And you know what? I had to agree with them. It has always baffled me why real estate commissions are what they are. It's not really a negotiated thing. It's more like, okay, we're all in this club together, and this is what we charge. And whether it's you're working for one of the big companies, when I got into the industry, I worked for a company called John Douglas. John Douglas, along with Fred Sands, really cornered the market here in the California market for, I don't know, a long time. And then they sold out to Coldwell Banker, and now we have a whole bunch of new players over the last 20 years. Regardless, the commissions that are paid, and now that it is not necessary that the seller pay those commissions, meaning that the whole structure of how real estate is bought and sold and the use of a professional real estate agent is turned upside down. So I wrote in my little notes, the outlook is... and, of course, the future without guaranteed shared compensation. That's what's going to happen. So what happens to a buyer's agent when the buyer in this market is just trying to squeeze every dollar into the purchase so that they can get a mortgage that they can afford? They're not going to be able to pay 2, 3, 4%, whatever the percentage is that's negotiated with the buyer's agent. And yet the seller is saying, I'm not paying for that. So what happens in buyer representation? My opinion is that buyer's representation will become something that is cheaper, and also the advice will become less worth it. And so you're going to find dual agency, i.e. the selling or the listing agent representing both buyer and seller. And they'll be able to do it at, 4% or 3% or whatever they negotiate. But that's what's going to happen. So the buyer's agent in general, unless we get into a market where the buyer actually wants to spend 2.5%, 3% on an agent, but I can't, as a guy who's been in the industry for a long time, I don't see any buyer willing to do that, because most buyers were always grateful that they didn't have to pay for commission, because they could walk into a deal, even though they do pay, right? It's in the purchase price. Even though the cost of the house and what they're trying to do to purchase that house, the commission's built into it. Now, the appraisal aside, this commission is now going to lay on top of that. So for the buyer who's just trying to squeeze into any property they can get into, that one, they can afford the down payment, two, that they can afford the mortgage payment, they're not going to be able, unless they can borrow it. Now, I know in the lending world, we frown on that. the amount of money that you need to close your transaction called closing costs. So is the real estate commission now going to be part of the closing cost, which the borrower would then borrow and then pay the agent? I don't know. It's all kind of, it's screwy. But how we did it is not how we're going to do it. And that's what's really on tap probably for the next 6 to 8 months till it's ironed out. Most of the real estate firms involved in the lawsuit have now gone away from forcing their agents to join the National Association of Realtors, which is really where regulation on realtors has kept government regulation out of it, because NAR has a code of ethics. NAR is really setting a standard, and they basically police themselves. Well, now, if we do not have that, you'll have more government involved in what we're actually trying to do, which is buy and sell, represent buyers and sellers in property. Anyway, it's very interesting. The lawsuit was in Missouri. It included both Kansas and Illinois properties, so it's interesting. Look it up. Read for yourself. But if you're in that market right now, it is very, very important to take a look at that and find out what's in your best interest. Is it cost savings or is it professional help? And if you go with a dual agent, i.e. your agent is also the listing agent, there are some problems there too, because you can't really separate the knowledge of one versus the knowledge of another, and closing the deal, there's more money in it for this agent. So there's a tendency to neglect certain items within the transaction, which might discourage one side or the other. Anyway, these are my thoughts on it. A couple other things here in California. The insurance companies are fleeing California. They're fleeing Florida. They're fleeing a lot of places where there have been not only weather events, but any kind of fire or earthquake or any major event which has happened. In California, Allstate, State Farm, Meristar, Uniton, Kemper, all out as insurance companies here in California. Can't afford it. They stop issuing policies, and they've canceled the policies that they've had. So not only adding to the stress of buying a house, which is your mortgage, which is the amount of money down payment, which is the cost of the house, you only have insurance problems because you need insurance, you can't get a loan, and you also have the agent problem, which now you're not quite sure whether you can even afford to buy or get into a house without a real estate agent that is also representing the seller. These are all things you got to look at. Okay, we got about a minute and a half left. I just wanted to get quickly to one other item, which I thought was kind of interesting. Okay, so I talked a little bit earlier in the show about phone scams, and it's that time of year, and any time around the year, around the holidays, there seems to be an uptick in what this is. So let me just, there's 4 of them here, and I'll just get to them pretty quickly. Okay, phone scams. Threat actors targeting Amazon users, specifically anybody who has an Amazon account. There are people who are calling you up and saying, hey, you have problems with your Amazon account. We need to verify your account information, and what exactly can you do in order to do that? And they get you to give them sensitive information about your account. Then they go about buying things on that account that then you will be charged for. That is a scam going on right now. In conjunction with that is the text scam. It's the same as the phone scam, except you get a text. I've had many of them. And as I say, if you're an employer, tell everybody if you get a text or a phone call or an email that you don't know what it is, delete the thing. If it's real, they'll get back in touch with you. If it's not real, you never have to worry about it again. But the text messages are the same thing. Hey, we see that you made a purchase. We want to make sure that it is you. Could you please click on this and verify your information? Well, don't click on it. Don't verify anything and block the number. These are all things that you need to do in order to protect not only your security, but also the money, your account, anything that you value that people can get at if you give them any sensitive information. The fake insurance Medicare scam fraud. Now, this is an old one. It's been around a long time. People call up and say, hey, listen, you're about ready to have your policy canceled because of non-payment. And then you argue with them, and then you end up giving them information about you and your account, and then all of a sudden there is fraud on your account because now you've given them sensitive information, which can be either used as identity theft or used as charging to your account from other services that they can get access to. If that happens, if you get any of these phone calls, it's like the IRS phone call or the IRS text or the IRS email. They don't do any of that. The IRS sends you a letter. That's how they communicate. That's how you know it's them. Anything else, ignore, delete, block. However you get rid of these people, that's the way to go. Anyway, I'm Jeff Barton, your voice in the mortgage industry. We'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for listening in, tuning into the show each and every week. KCAA, big towers out in the Inland Empire, San Bernardino, Riverside counties. Hello to everybody out there once again tuning in to hear what we have to say about the mortgage market and certainly about the real estate market. I am Jeff Barton. If you want to see this show, you can go to YouTube, Jeff Barton, The Mortgage Voice. We got a great website, themortgagevoice.com. We're on, a number of different podcasts, as well as, just regular terrestrial radio. As I said, KCAA. You can see it on your dial. We're on there Saturday and Sunday. You're driving around, either coming back from church or you're going to the hardware store. Tune us in. We can give you good information about what you're going to need to do, whether we're talking about macro, huge issues, or smaller type issues. But in the mortgage world and in the world of customer service and helping people get mortgages, Livier Becera is one of my most favorite people to have on the show, and she joins us once again. She's with Malibu Funding. You're still with Malibu Funding, I guess, yes?
Yes.
Okay, excellent. Well, thank you for joining us, and thank you for coming on the show.
Oh, it's always nice to be with you guys talking and chit-chatting.
Yes, and thank you very much. Livier and I were talking off air about the NAR lawsuit, the lawsuit against them for kind of price fixing. I think it was more about collusion to keep real estate commissions high. And we boiled it down to what's going to happen when a buyer needs representation separate than that of the seller, and they're forced to cough up 1.5%, 2.5%, even 3%. And as I was saying, I don't think they're going to come up with a nickel. So what does that mean with buyer representation?
Well, that will be very interesting to see how this all rolls out. I mean, as it is, houses are, the inflation. Houses are so expensive here in California. There's, the market has already started to decline, and because the rates are so high. So now, you're seeing houses reduce price. Okay. And if you take away commissions, then they have no representation, and buyers are already paying enough just to get into a home, even on an FHA.
Yep.
People who are, new homeowners, they've saved and saved and saved, and now they're buying a house for double, and also, their 3.5% just turned into 7%. So, they're not going to be able to pay. I mean, the only thing I can think is the sellers are either going to have to lower the price. It'll obviously bring the market down, or they're going to have to do large seller credits, which even on investment, you're only allowed 2% on primary, 6% or non-recurring closing costs, and so I don't know. Were they trying to automate it and try to get rid of realtors? I don't know, but then they leave sellers with no representation and buyers with no representation, and that would be worse.
I don't know where it's headed either. To me, it's been I agree with the lawsuit in principle, but I also know that people who are professional need to get paid. And if they hang out a shingle and say, I represent buyers only at 2.5%, well, they're going to have crickets and dust balls floating across their floor. They're not going to be doing anything because nobody's going to do that. Who's going to just sign up with some person on a, like you would sign up for a lawyer or a doctor or, it would be services provided. And you don't know what services they're going to provide until you have to hire them. It's I don't know how it's going to shake out.
Right. And well, again, I mean, the only way, it's like the only person in the transaction is the seller with the deep pockets.
Right.
If they're selling their house, they got money that they can pay out, regardless. I mean, if they want to put a cap on it, a percentage, like on a tier level, maybe they can do something, but they can't get rid of the commission that they're going to pay. It's not going to work.
Now, in FHA loans, can the borrower borrow closing costs and have the real estate commission thrown into closing costs? That was the only thing I could think of as an advantage for maybe some borrowers, although you don't want to borrow that money because you're paying interest for 30 years on it.
Well, I don't think so. I mean, they're already financing the upfront fee of 1.75, and you're going to throw that on top of it as well. So I don't think that they're going to be able to go above. We're at 96.5, but really we're higher because it's the upfront fee also thrown in there. So I highly doubt that, because they're going to be financing above what the house is valued at. It's just not going to work.
Okay, we're going to shelve that. You mentioned several things. We can't figure it out. I mean, this just happened. I read about it today.
I mean, it's good thoughts. They're good thoughts, ideas to throw out there, but they're just not going to work.
No, I know. I don't know how this is. I really don't know how this is going to shake out. And we're really at a point where it's so difficult to buy a house, as you said, in Southern California, San Bernardino, Riverside counties where the show is, as well as the other markets that we serve online. It's just, what is going to happen with interest rates, house prices, house building, and the availability of funds? Are these things all unknown at this point?
Oh, of course they are, because we have no idea where the economy is going. Inflation, if it continues to go up, then the market will continue to decline. You and I both know election years, rates usually go down, but this is much different. I don't think I haven't seen rates this high. I've been doing this 23 years. I know that it was like this in the 90s and even higher even before that. It's just we have not seen it, in a very long time.
2001 was the last time we had it like this for this long.
Really? Okay, so I got into business in 2001. I remember it was more like 6%.
Okay.
6.5%. So, but I remember I actually co-signed for my parents in '97, and it was 8.5% back then.
Okay.
So it wasn't too far off. So you're close.
No, I signed a loan docs in 95. Was it 94, 95? 8.75%. So
okay, so yeah, so that makes sense. Right around then, that was the going rate. So, but again, houses were much cheaper. So this is like I said, this is a different animal. You got houses that are $1 million. They want 8.5%, 9%. If you want a second, might as well take out a personal loan because it'll be cheaper.
Right.
It's just it's a very different time. But we got to stay hopeful. We ride the roller coaster. This is what the market is. It's always been like that.
Yep.
And I honestly, in the last week and this week, we actually saw a little dip in interest rates. So maybe we will be going into the election year with some, hopefully a little bit less,
So, okay, tell me about your own personal business. You're always busy. You're always doing things. You're always able to help a lot of different people, regardless of the market. Has it stayed pretty consistent for you?
Yes, but I also do real estate.
Okay.
So I always have, buyers. I have either a few listings or buyers that I'm working on, and also my loans. So sometimes, one will dominate more than the other, but I try to stay. And I've been doing it 23 years, so
Sure.
I have a pretty good sized database, and I really don't market myself, but I may have to.
Well,
depending on how this market goes, Plus, I have a big family, lots of friends, so God bless them all for
exactly. You need the family friends in any market, but certainly in a market like we have today.
Yes, exactly like we have today. So, but I'm always hopeful. To me, it's not as bad as it was in '08. In '08, I was scrambling.
Yeah, and '09 was a terrible year. I agree.
'09. We got through it, thank goodness. And
but again, everything was cheaper.
It isn't as bad. Everything was cheaper.
I went out to dinner, right? Now, dinner, okay, so there's two of you, you go out to dinner, you spend, I don't know, $60 to $100. I mean, I can't go out to dinner now and pay under $100. I'm like, what happened to restaurant prices? I mean, pasta is pasta. Absolutely. I mean, if you order anything, it's still, $35 an item. I don't know how people are doing it.
Right. No, absolutely. You got to find the specials. I just had lunch at BJ's. They have Wednesdays $11 hamburgers with endless fries.
Oh, you see? Okay, everybody, that's a good plug, by the way. That's pretty good. No, that's very good. You got to know all the specials, know when to go out, when not to go out. Yeah, you got to really track it. Start clipping coupons again.
Exactly. Or just start cooking at home,
Yep.
Good old homemade meals are healthier, anyways. But, and especially now, if we have time, which the past 2.5 years were just a blur. I mean, I was working from.
It's true.
I was telling my hours are from when I open my eyes to when I close my eyes. That's my hours are. They're no 9 to 5.
You're right. It had been busy, although it's been kind of like this for another year. Anyway, we're up against the time clock here, as Daryl's giving me the close it up signal. So thanks for coming on the show once again to tell people.
Thanks for having me.
No, I always love having you on, and I want to continue to do it. So again, appreciate it very much.
Awesome. Thanks.
Could you let people know how to get in touch with you?
Yes. Livier Becera. You can call me Liv. My phone number is 626 area code 712-9920. That's 626-712-9920.
Thank you very much, Livier. Very much. Always loving it. We'll talk soon.
Thanks, Jeff. Take care.
Thank you very much. That's Livier Becera from Malibu Funding. I'm Jeff Barton, your voice in the mortgage industry. We'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning into the show, to listening to us each and every week as we come to you through the KCAA towers out there in the Inland Empire, the IE, San Bernardino and Riverside counties off the 10 and the 15 and all those great places, even as far out as Palm Springs, even a little bit of LA County and Orange County as well. Thank you for listening to the show, and we try to bring you some information that's helpful. We've been talking earlier in the show, myself as well as some of the guests that come on the show, about the latest happenings in the world of real estate and how that might affect you when you're trying to get out there and get a mortgage or get a property. Bringing to us the information that is probably best known by the expertise that she brings to it is Brenda Scott. She is a loan officer for Malibu Funding, and as everybody in California knows, most loan officers are also real estate agents, so they derive some of the income from that as well. Brenda, how are you? Nice to have you back on the show.
I'm good. How you doing?
I'm okay. You know what? I just there's so much going on in the world. I try to focus laser on something which is not so stressful. But again, I get whacked with this lawsuit, the culmination of it, which is basically that NAR is found guilty of collusion. Berkshire Hathaway, Arrive Homes, a number of the other big firms, $1.8 billion was the damages from.
Oh, wow.
Yeah, it was a Illinois, and Missouri lawsuit, but that's going to spread to California as quickly as possible.
Oh, for sure, and it's going to be double or triple when it comes to California.
Yeah, they were saying maybe $5 billion. I said, it's $5 billion here in LA County, probably. Jeez.
Wow, exactly.
So you got buyers out there, right? They're worried about the down payment. They're worried about the cost of the house. They're worried about if they can afford the whatever closing costs that they can come up with. They're shopping around. They're trying to find the best representation possible. This falls in their lap. It's going to change the way people do business. Buyers are already nervous. How are you reaching them, and what do you think you can be able to offer them and by way of sort of calming them and trying to get them to either use you as a realtor or be able to trust that the people they do use are going to be in their best interest?
Well, I definitely think it's going to be major chaos because dual agency already is not a good thing to proper representation. Then we're going to see a lot of lawsuits going on against that seller because there's a lot of things that are not disclosed when you try and get everything all disclosed. So imagine not having that kind of protection, and buyers it's just that little old cliche saying, buyers beware.
Yep. No, I like it. And I like the fact that you're blunt with your assessment of the way properties are really sold. I mean, we all see the pretty commercials on television and, the beautiful couple who are, happy and having that glass of Chardonnay because they just bought their perfect. Well, that's not the way it is in the real world.
Oh, no. That's not the real world.
No.
once you sign that contract, that's when the work really, really starts for that agent. I mean, you have to get home inspections, and some of these homes. I mean, you get disclosures, and everything is supposed to be disclosed, but it is not disclosed at all.
Right. No, you and as a buyer, you used to have the agent be the one responsible. Now all of a sudden you're asking the listing agent, the person who has the property listed, to be your agent as well. I mean, how's that?
So whose interest are they going to have?
Correct.
You as the buyer, or are they going to have the seller's interest because that's who they're representing, the seller?
Right. And I think for my money, having representation that is solely mine is something that I want. But most of these buyers cannot afford 2% or 1.5% or whatever you're going to charge them, especially with the prices the way they are. Your average real estate price, San Bernardino, Riverside counties, LA County, and Orange County, if you add it all up, it's about $700,000-800,000. Well, 1% is 8, 2% is 16,000. There's no buyer out there that's going to want to fork over 16 grand just to get you as a representative. They go, "What do you do?" And go on.
And
You're people who are looking for a loan in a market like this in order to calm their fears.
You have to be very honest, and you have to get maybe pricing from 2 or 3 different lenders. You need to shop that loan for the best. Now you have to get the best interest rate at the best cost. And then you talk about a buy-down rate, and sometimes buy-down that rate is not even worth the amount of money that is costing you to buy that rate down.
Right. It's
you just got to shop it. You really got to shop it, and shop it where it's not affecting your borrower's credit and you got to have a lot of patience, Jeff. You just got to be patient. And I'm saying this, but you need to trust who you're working with, and that has your best interest and not their pocketbook as a best interest.
I know. I just saw some rules that they're trying to get in place for stockbrokers. Now, you imagine that they're not fiduciaries like we are in the real estate world, but they're not. Very few are, and trying to get these types of rules in place for all financial transactions. So where is the answer for you and your clients and the people you talk to?
I just either you're gonna buy now, and you're gonna buy with the interest rates being a little higher, and you can negotiate, hopefully get a good deal on the price. Pricing is going to come down. Mm-hmm. So you may have to buy at a high rate, and you're buying in an area that you want, you like, in a house that you love, and you'll be able to refinance that in, maybe 2, maybe 3 years max. And now you got a lower interest rate in the area that you want to live in the house that you love.
Right. No, I think that's right. I mean, we're in the business. We see it go up and down all the time. I just know that there are buyers out there who haven't been through this process before. They're nervous. They see the way the world is, and they're going, "Oh man, I'm just not going to be able to afford a house," and trying to calm them.
Well, you almost can't afford rent too, because rent is just as high as a mortgage.
Yeah, no, that's true. That's absolutely true. Yeah,
and you don't own it, and you can't write anything off. So what do you do?
I agree. You're singing to the choir here. I'm all about property ownership and getting into the property and figuring financing through the term of the ownership that you have in it, whether it's 2 years, 5 years, 10 years. Right.
Yeah. I have a client that he got to turn a car back in because he can't afford a $1,200 car payment and a house payment.
Oh man. So what happened?
Why would you go out and buy a new car and you're trying to buy a house? You can't have both.
$1,200 is not a cheap car payment either. I don't know what you're buying.
No. But you got to keep your credit right, though. You can't mess around and have 2, 3, 30 days late. You can't have no late on anything because it will affect your credit.
Yeah, and your credit is all about the rate you're going to get. So that's
your FICO score dictates
right.
what kind of rate you get. Absolutely.
Right. Hey, Brenda, we're up against it once again. This is too short of a time to have us have a conversation. We got to make these interviews a little longer next time.
I do. I like it. I like
Yep.
it. I like it. I like it. Thank you so much.
Thank you so much.
Yes.
Always enjoy having you on. You're one of my favorite people.
Oh, good. I'm good. I'm good. I'm glad to hear that.
You're welcome. Give people a way by which they might be able to get in touch with you as well.
I
Please.
can be reached at 562-500-2400. It's a free call. Just call me if you have any questions, refinancing or purchase.
Excellent. Brenda, thank you very much for coming on the show.
All right. Thank you.
Thank you.
See you guys later.
I'll see you later. That's Brenda.
Bye-bye.
Brenda Scott from Malibu Funding. I'm Jeff Barton, your voice in the mortgage industry. We'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning in to the show. Hey, you know what? We have a great website. It's themortgagevoice.com. It has been built and developed for you, the listener. Go there. You can see who's on the show. You can contact them directly. There are some a limited number of shows on the particular website, but if you want to see the entire archive, go to YouTube, Jeff Barton, The Mortgage Voice. That YouTube has shows dating back a long, long time, well, hundreds of shows on there, and certainly that's the best way by which you can see what we do, how we do it, and if you like it, click that you like it. Join what we do each and every week, and tune in on Saturday and Sunday at KCAA out in the Inland Empire. If you're not hearing or seeing us through any of those means, well, we are going to be hard to reach anyway. So I'm Jeff Barton. This is The Mortgage Voice, and thanks very much for tuning in. The people who come on the show, I'm always happy because a lot of them are my friends. A lot of them are people I've known for a long time and are experts in what we talk about on air. Luke Manke is certainly one of those people. He's a loan officer for Malibu Funding. Luke joins us now. Luke, how are you?
I'm good, Jeff. I'm very good. Thank you. How are you doing?
I'm okay, too, and thank you very much for coming on the show. As we talked a bit off air, and as I have to several guests on the show today, we were talking about the implications of the seller having to pay or not to pay the commissions in a real estate deal to the buyer's agent, what ramifications that would mean, and it's through a lawsuit that has been won out in the state of Missouri, which encompasses Kansas and Illinois, and there are a number of other lawsuits out there. This one was against Berkshire Hathaway and a couple other companies and NAR. Just give us your thoughts. I know you're involved in real estate all over the country. How do you think this might affect not only the transaction itself, but our ability to bring loans to our customers?
I hadn't thought about how much it would affect us because initially, to be perfectly honest, I didn't think it would affect the originators so much, but maybe I'm wrong with that. I mean, it's definitely going to, it's going to shake out all of the average to below average realtors, I feel like, in a lot of places because they're going to be fighting for those listings. And I would think, of course, this is all going to kind of shake out, but I would kind of tend to think that maybe there's going to be some of those buyer's agents that will, agree upon a certain amount that the buyer will pay them, or they're just going to go after the listings where they're going to write offers. And I don't know, maybe you know this, but can they just write an offer at a price that the seller is still to pay the whatever, whether it's 4 or 5% or whatever?
It becomes all a negotiated deal. The only thing with the originator I was thinking about is if the buyer actually had to come out of pocket for commissions, and that would detract from either a buy down of the rate, closing costs that they may have to then ask for the seller to give them. It complicates the deal. And basically, less transactions is not good for the originator. We're struggling for what we have now.
Yeah. I mean, it's probably going to have a little bit of effect. It's going to take a while, but it'll probably have an effect on price. You're right. It's going to steer them to houses that are either cheaper, that they can afford to pay and cover the down payment, or
Right.
prices will go down, or I mean, it'll definitely affect us, I guess. But I also feel like, as an originator, we all had to adjust
Yep.
to the 2008 regulations and reducing our pay, and everything is disclosed on the up and up, and that's all negotiable. It's off the loan amount, and now it's going to get real for these agents, I suppose, where they don't just get that automatic, non-negotiated 5% or 6% or whatever. They're going to have to work a little harder for it, especially. I'm going a little bit off tangent here, but I don't know if it's fair for the agents selling $2, $3, $5, $10 million houses and still getting 5-6%, and these other ones that are selling $400,000 or $500,000 houses and work off and making a lot less. So maybe it'll make it a little bit more of an even playing field. I don't know.
Well, I do know that anybody who's selling a house, like you said, $4 or $5 million, they're not getting 5 or 6%. That's all a negotiated fee. Normally, and I live in a town that's got a lot of those kind of houses, even like $20, $30, $40 million houses, and all that's a negotiated fee. Imagine paying 5% on a $40 million property. That's insane. No, nobody would do that. So they negotiate a price, and whatever it is, and they usually split commissions. I think a lot of firms will continue to split commissions. Everybody's just going to make a lot less, and that's going to, maybe help the market, maybe not help the market. But you've had a different point of view about the whole thing, and I think it's refreshing to hear that, because we can sit and judge and complain, but until it shakes out, we're not going to know what's going to happen or what the new real is. And I think that, as you said, in '08 was exactly what happened to the loan officer. They all of a sudden became this licensed, federally NMLS, state regulated, all fees disclosed up front kind of salesperson, and maybe that's where we're heading, and maybe that's a better thing.
Yeah, it was frightening and frustrating, and it took me years to get comfortable with negotiating fees, and then finally you kind of you lock in on it, and then you just accept it, and it is what it is. And yeah, I'm sure it's going to be hard at first, but everyone will adjust. It's always the constant in this business is change, and this is just more change. And I never thought about it. I'm sure a lot of people never did, but once they heard it, their minds were blown. But then they're like, "Wow, I'm actually surprised it took this long for somebody to realize."
That's so funny. I agree. I thought the same thing. I said, "Wow, they've been getting away with this since when? 1913 or whatever the DRE was around, or whatever the NAR or whatever it is." Yeah, I kind of agree with that too. Okay, let's shift gears just a little bit. So we have a market where real estate prices are up. They're a little bit flat this month, but they're really up over the last year, 2 years, 3 years. And certainly mortgage interest rates are really up. Availability of funds, the difficulty to actually find a loan that fits your particular client. What are you doing? How are you doing that? And what are your clients thinking?
Not easy. It's been tough to accept the prices and the rates and the payments, but I still, and I could be a little bit of an outlier, but I have a lot of buyers that are looking to buy primary residences, and they're just taking the plunge. And we're closing a couple this month and 2 more next week, and it's all purchase, it's all primary residence, and they want the house. It's a long play. They feel like in a couple of years, they're hoping 2 or 3 years, they're crossing their fingers. If rates come down, then they'll just refinance and drop the payment. But I don't know. It's going to be ebb and flow, and it's probably going to be ebb a lot more than flow for the next year.
I don't know. Yeah, I look at the real estate market, and I look at the mortgage interest rates, and I said, we cannot continue here in Southern California with both of these things going up at the same time. It just makes zero sense, because you're forcing people to make choices that shouldn't be able to make. And as our last guest pointed out, the rents are no better. It's not like you can say, oh, I'll just rent for a while until the prices come down, because the rents are also high. And I think, personally, it's all this corporate money that bought a lot of single-family residences and aren't keeping them on the market to buy and sell. I think that and the low 3% mortgages, we just don't have inventory.
Yeah. And you're right with the cost. I mean, just everything. We're doing a condo right now, $580,000 condo, and we couldn't get insurance for it. We got one option, and all we needed, and this is probably getting into the weeds a little bit too much, but we just needed walls in coverage for like $150,000.
Right.
That's all we're covering, and the premium is like $2,500 for the year.
And can you get it?
$500, but nobody wants to write insurance on condos in the state. There was another one in Palm Springs, and it was also a 1,500 square foot condo. The premium was like $5,200.
That's unbelievable. That's ridiculous.
Like, what's that going to do to rent?
Right. Now, I did earlier in the show talked about a lot of insurance companies bailed on California, State Farm being the biggest. It's a problem. Obviously, the state's going to have to legislatively deal with the issue like they did with the California Fair Plan. Have to.
Yeah. No, you're right.
Luke, we're up against it. I'm sorry to say. Could you please shout out a way by which people can get in touch with you? As one of the most. Sure.
You can reach me direct on my cell phone, 818-209-2592. More to talk about. We'll do it next time.
Excellent. Thanks very much, Luke, for coming on the show. Always appreciate your expertise and opinion. Thanks very much.
You're welcome.
Thank you very much. That's Luke Manke from Malibu Funding. I'm Jeff Barton, your voice in the mortgage industry. We'll see you next time.
You're listening to The Mortgage Voice with Jeff Barton. For more on today's topic, visit www.malibufunding.net.